Howdy, Jacob here. Today we're looking at Concentrix Corporation. They are in the IT services industry. 4.3 billion market cap, over double that enterprise value. That part turns me off immediately, but I'm still going to dig farther. So, to under 2 billion revenue growth to over 7 billion, massive growth. But again, take everything with a grain of salt. 'Cause if they've just gone into debt to fund everything, that debt's going to become due. And then what are you going to do? Dude, gross margin in the mid 30% with a pretty low operating margin for business in the IT. It's kind of surprising. So, what do? They engage in the provision of technology infused customer experience solutions worldwide, founded in 2004. So, they're still growing quite a bit. So, these margins, I mean, the gross margins are a little bit concerning me, but the operating margin, maybe that could be in the mid teens, low 20s, possibly if they become more efficient. They're paying a dividend. Not sure I like that. Try to invest a capital, averaging mid single digits, but again, they're reinvesting a lot. It looks like. So on this income statement, they actually don't have R&D spend, so I wonder if that's truly the case. But share growth is abysmal. That's good. They're not just diluting shareholders. They have 295 million cash on hand with almost 5 billion in long-term debt. I'm going to assume that they're making some acquisitions here. Let's see. Cash flow statement, 2 massive net acquisitions here, and then one back in 2018. So they're funding these acquisitions by going into debt, and then otherwise their use of cash flow is share repurchases and paying a dividend. The dividend currently at 1.8%. That's a pretty substantial dividend, to be honest. But in relation to cash flow, you can easily afford it. So we're going to make some assumptions here. And I don't like companies just going into debt to fund projects, especially, acquisitions make sense because usually you don't have the money at hand to pay for that acquisition. But I think that for me, I'm going to dampen the growth quite a bit because I'm not going to assume that, 200% of their free cash flow is going to acquisitions. I'm going to make it 100%. That's the way I personally put my conservatism into my projections, is by saying I'm either going to put debt reduction into the 100%, or if they don't have debt, I'm not assuming over 100%. So for me right now, I think I could see their growth maybe 8%. They're still small, but they're going to be focusing a lot more on debt reduction. So this is probably assuming 20 to 30% to acquisitions. Their dividend, I don't plan on raising that. They're still growing, so that's where paying a dividend is weird. They can easily afford it. 76 million of their almost 400 million, so it's less than 20%, but still keeping that where it is. We're at about 50% capital allocation. We'll use about another 20% to share repurchases, so that's just going to offset their stock-based compensation pretty much. For margins, I do think that they can be higher. Let's do a range here, though. So let's do 6 and 8%. I just still want to be conservative. And then on the PE, price to free cash flow side, there's still good growth ahead of them, but their enterprise value is a lot greater. So we're leaving about 30% capital allocation to debt reduction, which leaves about 120 million. It's going to take quite a while to reduce that. So I think enterprise value is still going to be quite a bit greater than their market cap. Probably not double, but we're looking at probably 50% higher. I don't know what their price point is going to be. We're just making projections here at this point. I do think still they'll have a lot of debt, though, in relation to what their company's worth. And so at that point, maybe just market average, because I do think they're a better than market company. Wow. Okay. We got to a price point that looks like a screaming deal right now. So we're going to have to do more research on this. And, sometimes when you do a present value calculation, we don't necessarily take into consideration the debt. Like obviously here, I just talked about maybe they deserve a 17 if they had, or 17 or 18p if they had no debt. They do have a little bit debt, 15. We're going to see whether that's truly the case that we think about or not, and whether these other assumptions hold. So hopefully in not too long, I'll do a deeper dive on this company because it does seem fairly interesting based off my initial assumptions. I might have been a bit rosy on a few of these, but this will definitely be another company that I'll have to put on my review list for a deeper dive. Hope you enjoy the video and have a great rest of your day. Thank you.